What is a financial crisis? It is considered by many economists to be the worst financial crisis since the 1930s, when the Great Depression occurred. In November 2008, of the 4.7 million small businesses in the UK, as many as 50 were closing each day, and it was suggested that the rate could increase, according to a poll by the Federation of Small Businesses. It took a year for the financial crisis to come to a head, but on the 15th of September 2008 it did, when the US government allowed the investment bank Lehman Brothers to go bankrupt. This is a diagram by Jeffrey Frankel, who is a professor at Harvard University. Here, he attempted to demonstrate the origins of the financial crisis in one slide. The diagram shows the 5 origins at the top of the slide, which link with other factors to ultimately cause the recession of 2008, which was mainly brought on by the financial crisis of 2007. However, the slide is biased towards the United States, so not all information may be correct for the crisis of 2007 as a whole. One of the main origins was households, as they were saving too little and borrowing too much. This is due to people not having enough money saved to buy a house, but they were able to receive a subprime loan in order to obtain enough money to buy their house. This increase in people being able to buy a house caused a housing bubble, where house prices rapidly rose when no one was expecting it to. One of the main drivers of the crisis was subprime lending. Subprime lending is when a bank provides a loan to a borrower with a low credit rating or an income that isn't steady. The loan is often secured on a low-value property if a mortgage is taken out. Lenders will charge higher interest rates for a subprime loan compared to that of a conventional loan, as the bank seeks to compensate for carrying higher risk. This is due to some subprime borrowers defaulting on their loan as they are not able to make the repayments. However, it can also be argued that reducing the interest rates of subprime loans may decrease the risk of defaulting, as the repayment is of a lower value, so the borrowers may actually find it easier to make all payments. Another of the main drivers of the crisis was leverage. Leverage refers to the use of debt to acquire additional assets. Leverage is attractive to a household because it offers a high rate of return if the asset price rises. Banks increase their borrowing to extend more loans for housing and consumer durables like cars and furnishings, but also to buy more financial assets based on bundles of home loans. It actually became more profitable for banks to become more highly leveraged. The graph shows the leverage of US investment banks and of all UK banks. In the US, the leverage of investment banks was between 12 and 14 in the late 1970s, rising to more than 30 in the early 1990s. It peaked at 43 just before the financial crisis in 2007. By contrast, the leverage of the median UK bank remained at the level of around 20 until 2000. Leverage then increased very rapidly to a peak of 40 in 2007. Another main driver was the Lehman Brothers bankruptcy. Investment banks such as Lehman were not subject to the same regulations applied to depository banks to restrict their risk-taking. One measure of this risk-taking was its leverage ratio, a measure of the ratio of assets to owners' equity, which increased from approximately 24:1 in 2003 to 31:1 by 2007. On the 15th of September 2008, the Lehman Brothers Bank filed for bankruptcy. The US government decided to not step in to save Lehman Brothers in order to show markets that they would not and could not rescue every troubled financial institution. On the 18th of September, just 3 days after Lehman Brothers filed for bankruptcy, the US Federal Reserve, Bank of England, European Central Bank, and Bank of Japan sought to douse the global banking system with £101 billion worth of cash in an aim to help restart lending between banks, which had all but dried up since Lehman's collapse. So how did the crisis spread? First was growth. People with poor credit histories are given high-risk loans by US banks, which is also known as subprime lending. Along with other loans, bonds and assets, the high-risk loans are bundled into a portfolio and sold to global investors. Next up was subprime problems. The rising interest rates and falling house prices lead to a high number of mortgages being defaulted, aka the mortgages aren't able to be paid by the owners of them. Investors suffer losses due to not receiving payments, so are reluctant to buy more portfolios due to the risk. Credit markets also freeze, as banks are reluctant to lend to each other as they don't know how bad loans are on their rivals' books. The next is the global effect. The impact of subprime mortgage crisis is shown to have implications outside the US. There are losses by investment banks as far away as Australia. Firms cancelled sales of bonds worth billions of dollars, citing market conditions. Next was the central bank intervention, as US Federal and the European Central Bank tries to bolster the money markets by making funds available for banks to borrow on more favourable terms. Interest rates are cut in an effort to encourage lending. Liquidity crisis. The short-term help doesn't solve the liquidity crisis or availability of cash for banks, as banks still remain cautious about lending to each other. The lack of credit to banks, companies and individuals brings with it the threat of recession, job losses, bankruptcies, repossessions and a rise in living costs. Next, the banks were in turmoil, as UK bank Northern Rock seeks an emergency loan to stay afloat, prompting a run on the banks as worried customers withdraw £2 billion worth from it. The bank is later nationalised by the UK government. In the US, near collapse of Bear Stearns leads to a crisis of confidence in the financial sector and the end of investment-only banks. The US bailout plan. Seeking a long-term solution, US government agrees $700 billion bailout that will buy up Wall Street's bad debts in return for stake in the banks. US government plans to borrow money from world financial markets and hopes it can sell the distressed assets back once the housing market has stabilised. UK bailout plan. The UK government launches its own bailout, making £400 billion worth of extra capital available to 8 of the UK's largest banks and building societies in return for preference shares in them. In return for its investment, the government expects to get a stake in the banks, although exactly how much was not quite clear. Global action. Economies around the world are affected by the credit crunch, as shown in the graph on the slide. Governments move to nationalise banks from Iceland to France. Central banks in the US, Canada and some parts of Europe take the unprecedented step of coordinating a half-point% cut in interest rates in an effort to ease the crisis and increase lending. And lastly, the stock market rollercoaster. Shares have risen and fallen with news of failures, takeovers and bailouts. In part, this reflects investors' confidence in the banking system. While bank shares have been hammered because of bad debts, retailers have been hit as consumer confidence is shaken by falling house prices and job security. The short-term main effects on the United Kingdom. Businesses face problems in securing bank support to consider their trading, and house prices have decreased by 25% from 2008 to 2009, as shown in the graph. The financial crisis significantly impacted on the UK's house prices. In recent years, however, the housing prices have started to rise. The Rightmove House Price Index revealed that the average asking price for a house hit a new national high of £294,800 in September 2015, with the assumption that by the end of the year it is poised to reach £300,000. The long-term effects are fall in retail sales, rise in unemployment, and GDP falling by 1.5%, so the UK officially enters a period of recession that continued through to 2009. Previously, the unemployment rate was remaining in the range of 4.3 to 6% between 2000 to 2008. From the spring of 2008, unemployment reached 8% within 1 year, rising to 8.4% in 2011. According to the Financial Times statistics, unemployed staff in the whole country rose from 48,000 to 2.7 million in the end of 2011, which is also the biggest jump since 1992. So how can economists potentially prevent or at least mitigate future crises? Well, first they can regulate how banks lend out money. This can be carried out such as more critical background checks, a more thorough assessment of the risk of giving out a loan. This stops banks using subprime loans, reducing the chances of defaulting a loan. This also allows banks to sell more portfolios as it encourages banks loaning to each other. And the second idea is that relative to their assets, banks should borrow less. This is because having a lower equity increases the chances of banks becoming in debt, as a smaller change in the percentage value of assets can result in the bank owing more money than it is worth, as shown in the diagram. Therefore, having a higher percentage of equity reduces the chances of a bank becoming in debt and filing for bankruptcy. This may be an incentive for investors to buy shares in the bank, as it provides a lower level of risk for their investment.